I think we are. I mean, the two factors here, the market is, well, investors are terrified of missing the famous Fed pivot. So they run ahead of themselves essentially on two things. One was the language that came out of the last FOMC meeting, where the Fed, not unreasonably, said they were going to be more data dependent rather than have some sort of fixed program. And secondly, some of the data which has shown at least cooling from the acceleration of inflation figures that we've seen for the last 12 or 18 months or so. So I think we need to look at those two factors and see what do they actually mean going forward from here. And I think there are two ways I'd look at this one. Firstly, there's pressure around the world for central banks to actually do better with their mandates. I mean, there's pressure here in the UK in the heat of a competition for Prime Minister. Liz Truss, the leading candidate, has already explained that she's going to probably call for a review. And apparently there was some dialogue last week between the governor of the Bank of England here, Andrew Bailey, and the senior Treasury officials, where in fact he indicated, having resisted this factor, that actually, yes, he was receptive or was at least going to cooperate. And that's already been announced in Australia. The Reserve Bank of Australia have put together a commission. They've included some outsiders, a former governor of the Reserve Bank of New Zealand, to precisely look at this issue. So I think that shows you the pressure that all central bankers, including Jay Powell, will be under in the next few months if inflation doesn't collapse, because the market's saying, oh, hang on a minute here, that we won the war completely, we won the battle, we won everything. And I don't see that way. So turning to the inflation figures and just picking out one example at random, I mean, wages in Lufthansa had to give away an enormous package to kind of bring peace back to Europe's very, very crowded airports and air terminals. They paid 5.5%, which is a very big figure in German wages. And if you drill down into the data, if anything, wage inflation is marginally accelerating in the Western world. So on those two factors, I see the Fed not pivoting for some time, probably not into Q1 or even Q2 next year. I see the figures coming through and being perhaps balanced. There'll be some good news because, yes, the economic data is slowing, and that takes off some of the immediate pressure that we were seeing earlier in the year. But I don't think it will be a one-way street. I think some of the data will be either strong in terms of, you saw the employment report in the US 10 days or so ago, and I think likewise some of the inflation data will be much more mixed. So in that environment, the markets, having kind of swallowed the pivot argument, lock, stock, and barrel, they're going to have to digest this. And I think we're going into the autumn, which is traditionally, again, a period of volatility. I think we will see fresh lows here, maybe perhaps in the beginning of next year. I think investors should be very cautious in not to be sucked into this rally.
And that's fascinating, because there are reports that some fund managers are having to play catch up here and are being sucked off the sidelines into this market. But can I ask you about this mentality now that we've got a 50 basis point rate hike now in September, not 75 basis points, even though some members are still saying they're open for 75 basis points at this stage. What's the downside of another big jumbo-sized rate hike when the Fed wants to get back to 2%? Why wouldn't they go for 75 basis points?
Well, I'm with you on that one, man. I think that it would take an enormous series of much, much more muted data for the Fed to kind of indicate that they have essentially pivoted. And I don't think they want to do that one. And I think, again, the Fed are not blind to what's happening in the market. I think the Fed will not want to see this enormous risk-on rally. I think the Fed will be concerned that the market is complacent here. And as you've seen, I understand, just listening to your earlier piece about some of the interviews that will be coming through thick and fast, I think the Fed may want to actually kind of knock this rally on its head and come out with 75 basis points. So I think the downside is at this level at 42 plus on the S&P, and the downside is actually quite considerable. The markets are overbought technically. The short covering, I think, has largely been flushed out. So I think we could be in for some quite interesting days in the next few weeks. I mean, obviously, nobody knows the precise trajectory of the next 100 points. So I'm not going to, second guess every movement here. But I think the Fed is terrified of being called out, and the market is terrified of the pivot. So we've got two things clashing. And I think the pivot now is kind of very much priced in. And I think the Fed will call out and will come through with 75 basis points, barring some very, very dramatic change in the data.